Bond yields are spiking, tariffs are flying, and your wallet? It's caught in the crossfire. But why exactly are US bond yields going up, just when you'd expect them to fall during a global trade war? And what could this mean for the economy, markets, and you? Let's break it all down, plain, simple, and razor sharp. US government bonds, especially the 10-year Treasury, are considered the safest assets in the world. When you buy a bond, you lend money to the US government. The yield is what you get in return, your interest. Now here's the kicker. Bond yields go up when prices go down. So when everyone is selling bonds, yields rise. And lately that's exactly what's happening. The US is back in a full-blown tariff war, this time targeting strategic imports from China with rates exceeding 145%. China? Hitting back with 125% tariffs on key US exports. So what does that have to do with bond yields? Well, trade wars mean higher input costs for manufacturers, rising consumer prices, slower global growth, and potential supply chain instability. But here's the twist. Investors are not flocking to bonds like they usually do in crises. Why? Because they're worried this time inflation might persist. And inflation is a bond killer. Why? Because bonds pay a fixed return. If inflation rises, that return becomes less valuable. So investors demand higher yields to compensate, or they just dump bonds altogether. Also, with sticky inflation, the Federal Reserve might keep rates higher for longer, or delay any cuts. That's another reason bond yields are moving up. For example, the 10-year yield recently pushed past 4.5%, signaling serious market concern about longer-term inflation. So why should you care? Higher bond yields affect everything. Mortgage rates rise, making homes more expensive. Credit card APRs rise, cost of debt goes up, stocks fall. As borrowing costs increase and growth slows, emerging markets struggle as capital flows back to the US for higher returns. Government borrowing costs spike, worsening the US fiscal outlook. And in the background, a weaponized trade war that's fueling inflation, even as global growth slows. This is the worst kind of stagflation risk. In the grand chessboard of global finance, rising bond yields signal that investors are nervous, not just about inflation, but about fiscal irresponsibility, geopolitical tension, and deglobalization. Countries are reducing their reliance on the US dollar and dumping treasuries in the process. China and other nations are reshuffling reserves, and US debt is less attractive than ever. This isn't just about economics anymore. It's a sign of geopolitical rebalancing. Keep an eye on Fed signals, inflation numbers, US-China trade escalation, treasury auctions and foreign holdings data. Because rising bond yields in a tariff war world, that's not just a signal, it's a warning siren. Like, subscribe, and stay tuned as we continue tracking the fault lines of the global economy. Drop your questions below. Let's decode the markets together.